John, I couldn't agree with you more. There's no doubt that the failure that we're looking at from the bank execs is inexcusable, without any question. You and I will probably disagree on my next comment, but I will say that an administration that prints and spends trillions and trillions and trillions of dollars that would be embarrassing to any drunken person with somebody else's credit card is remarkable. And having the Fed have 10 increases in about a year only exposes the vulnerabilities in a bank that is gambling on lower interest rates when every indication is they're going higher and higher and higher. And yet we don't have conversation about some of the underlying causes of an unstable, chaotic economy that leads to liquidity risks. On a different topic, it is no secret that these banks were rife with mismanagement. I've said it myself time and again, and now even the regulators and the reports are confirming this truth. But the use of emergency powers may be just as detrimental to the continuity of our banking system going forward. If the government is always there to intervene and bail out a failing bank, this could promote riskier decisions in the financial sector moving forward. With potential bad actors hedging their bets with the strength of Uncle Sam, how could they lose? And that's not a bet I want to see. Principles of risk management are based around the possibilities of loss. And if we eliminate the reality of failure, there ends up being no cause for prudent management, only a masking of bad decisions waiting to implode, like they did with SVB. Mr. Quadman, does the increased usage of emergency powers incentivize proper management? And you've already started that answer with John, with Senator Tester, without any question. But your last comment really struck me, and I wanted you to continue to expound upon this. This is a very important question. John and I both run businesses. And whenever you infuse in any sector the moral hazard that somehow you're just geniuses with no risk because there's no chance of failure, you do incentivize more and more bad behavior and less focus on the underlying issue of prudent management.
No, Senator Scott, there's a lot to unpack there, but I think you are hitting on the right points of we've had an issue of moral hazard. We've had an extended period of time of zero interest rates where management and governance was not necessarily keeping pace with that. Additionally, regulators are not keeping an eye on things as well. So when we had the cash go up, right, with the spending that was happening, and it had to go into bank deposits, there was not a sufficient focus on interest rate risk and the issues that had to happen there. The other one point I want to raise as well, and Senator Scott, where, as a small business person, regional banks are a very key player for Main Street businesses. They have been prudently acting, and I have not had the same esoteric issues here.
Yes.
But again, if the cop on the beat isn't enforcing the law, new authority isn't going to do much.
Amen. That's a good word. Since 2008, the FDIC has filed dozens of lawsuits and entered into nearly 1,000 settlement agreements with officers, directors, and other professionals related to loss suffered by banks placed in FDIC receivership. Such actions have led to recoveries totaling more than $4 billion. The FDIC has stated that it generally brings personal liability cases against the officers and directors of failed banks when there are these instances: dishonest conduct, inappropriate transactions with bank insiders, failure to establish, follow, or monitor sound underwriting policies and procedures, and failure to respond to concerns raised by regulators, accountants, counsel, or other professionals. Is there any reason to doubt that the FDIC has existing authority to hold senior leadership and directors personally liable?
No, we think the authorities are there, and clearly you cite the statistics that show that. Additionally, the Fed and other banking regulators have those authorities as well. But what is clear, even from the rudimentary information that we have with SVP and the other banks, is that sufficient action was not taken. And some of these issues in terms of, one of where management is not communicating problems to the board of directors, that's a red flag that should have been jumped on immediately and wasn't.
Yeah. two tools that work in your toolbox that you don't use doesn't mean you need a third one.
Correct.
Thank you.
Agreed.